Today, we were going to talk about a founder's take on the secondary market. Really curious to get your thoughts here, Phil. So, to kick things off, what is your overall take on what we're seeing in the market right now?
So, right now, I think there's a number of kind of themes to touch on across secondary markets, and I get pretty nerdy and passionate about the topic. So I'll try to keep it in broad strokes. I'd say one of the big new changes is that there are, unsurprisingly, a lot of AI companies that investors and shareholders are really interested in that have grown to really large valuations quickly. I'd say that's one big theme we're seeing. Probably another theme is really just the valuations of these companies and where they're trading. One thing that EquityZen likes to kind of really keep a close eye on is where trades are happening in certain companies relative to that company's last valuation. So we kind of think of like the last funding round as a good, kind of like watermark or like check on what a company's worth. We've seen that there's been a trend, starting in probably 2022 when valuations started to kind of decline relative to that funding round. We saw things trading at more of kind of a discount relative to that funding round starting in 2022. And we're starting to see that kind of bottom out and start to improve over time. So there's a couple trends for sure.
So let's set the stage by talking about kind of where we were in 2021 versus where we are now. What has changed and how has the market evolved in that time?
Quite a lot. So 2021 for secondary markets, this isn't just EquityZen, this is just broadly, for secondary markets was pretty crazy, really, really active, a lot of volume, a lot of things changing hands. And that's not that surprising if you kind of think about it. In 2021, we were in a time of a lot of stimulus for investors, right? A lot of kind of extra cash. A lot of people were still at home because of COVID, so they had extra time on their hands. There was GameStop, AMC, Robinhood, trading mania. There was still zero interest rate environment. And so private companies were raising a lot of money. What that meant for secondary trading was in pre-IPO companies is that there was a lot of activity because you had companies that were going to go public soon because the markets were open. And there were also, SPACs as well. We also had SPACs. And so you had a lot of investors that were really eager to make investments into private companies because they saw that there was a decent chance that that company could go public, get acquired, go through a SPAC. You could do well. So you had a bunch of pent up investor demand. And you also had shareholders that were very quickly having a lot of paper gains, right, at companies they worked at. You joined a company that was worth $100 million at the time you joined. 2 years later, they've raised money in 2021. The company's worth $1 billion. All of a sudden, on paper, you've got a bunch of illiquid gains, and you'd really like to monetize them. It's kind of like a perfect storm for EquityZen and other places that do secondary trading. So, ton of activity, and a lot of the trades were happening at the prices of those funding rounds, or maybe even at a price above those funding rounds. And when I talk about that, I kind of mean like in 2021, let's say a company raises $200 million at a $2 billion valuation. If we see trades happening at a $2.5 billion valuation after that, that's basically a premium, right? $2.5 billion is more than two. And then also you could sometimes see trades at a discount. So company raises at a $2 billion valuation. We see a trade at $1.5 billion. That would be at a discount. So 2021 was a time of peak market exuberance. At exuberance, you tend to see prices go up. We saw a lot of trades happening at maybe the price of the last funding round or even a bit of a premium to that round, right? Which is, if you kind of think about it in retrospect, it's pretty wild that some institutional investor puts in a couple $100 million into a company after doing all the evaluation of that company's documents, customers, et cetera, or you hope they do the diligence. And they decide the company's worth $2 billion. And then immediately thereafter, a smaller investor is like, oh, well, I would actually pay $2.5 billion for that with probably less information. So like I said, very passionate topic. That's 2021 in not so much of a nutshell, but a bit of a summary.
So now that we've covered 2021 and what that era was like, let's talk about the present environment. We're now in 2024. What are we seeing in the market? What has changed over the past 3 years?
Yeah, so quite a bit's changed since kind of the mania and excitement and exuberance of 2021. At a broader level, not just for EquityZen or for pre-IPO markets, but in a broader macro sense, interest rates are no longer zero. Companies are not raising nearly as much capital in the private markets as they did before. SPACs aren't really a thing. So, going public by way of this special purpose acquisition company is really no longer a thing. M&A has slowed down. And so you've had just a much slower market since 2021. all the way up until 2024, which is where we are now. 2024, what are some reactions or themes related to all of kind of where we got over the last few years? One thing is that companies trade at a much larger discount than the last funding round, which kind of makes sense, right? So if a company last raised at a high valuation in 2021 or maybe even 2022, and overall markets have come down since then, you would kind of expect that for someone to exchange shares on the secondary market, it would be at a discount to that kind of high water mark. So we're seeing mostly trades happening at a discount. I think we even see some trades that happen at discounts of 80% or more, right? So if a company was worth $2 billion at their last funding round, they're trading at $400 million, which is obviously a big discount. But like one take I'll share about all of this is in the public markets, this happens all the time. Like you buy a share of IBM stock, like it can go down 20% the next day. It can go up 5% the next day. Like prices are very volatile. In secondary markets, it takes a little bit longer, but when it does happen, it's like really crazy to like think about just because there's kind of a step function in between when these happen. IBM will trickle down 20% or trickle up 20%, or NVIDIA will start trading and go up. But it's not like one day NVIDIA is at $1 trillion and tomorrow it's at $2 trillion in valuation. Like that doesn't really happen that often in the public markets. But in the private markets, it almost feels like it happens that way because there's so much time in between each kind of trade that happens. So we kind of talked about like one theme, which is valuations. So they've come down considerably. And the other theme I would talk about is like unsurprisingly, artificial intelligence and AI, right? There's a lot of companies and a lot of capital going towards funding AI companies. There's big ones that everyone knows about. So, there's like ChatGPT, and behind the scenes, there's a lot of other companies that are either kind of along kind of the production line as it relates to generative AI, whether it's the software itself or it's the chips being used to run your software, or it's the tools to parse out data. You can have different verticals, right? You could have like AI for legal, you can have AI for B2B SaaS, you can have AI across the board. So there's just a lot of money going into it, and correspondingly a ton of investor interest, and therefore some interest in shareholders that want liquidity. But the really interesting thing about AI is that the companies are not that old. The space has grown really fast in a very, very short amount of time. Like you have, it's 2024, ChatGPT's been around for like less than 2 years. This isn't a thing that took 20 years to develop. And so why that matters for secondary trading is that typically you see liquidity from shareholders start to happen when they get impatient. I've been working at this company for 4 years. The company's 10 years old. It's never gone public. I need liquidity. I've got to address some liquidity needs I have as a human being. But consider that you might be at an AI company and you've been there for like 12 months, and all of a sudden on paper you're worth like millions of dollars. You don't really have the same argument that like you really need the liquidity now, right? Everything happens so fast. And so you don't have as much of a pent-up desire for liquidity from shareholders in the AI companies as you do for like more legacy, like private companies, which creates this really, really weird imbalance. There's a ton of demand for these companies. There's not a lot of supply available. Sometimes prices start to get crazy. And so AI might be the exception to like the general asset class where things might trade at like a premium to the last funding round because the funding round was very recent and there's a ton of excess demand.
So we've seen valuations really move around in the private secondary market, certainly from where we were in 2021 and then, the lows of the market in 2023 or so. So what are we seeing now? And is it a uniform story across the board, or are different industries trading at different levels? What are some of those trends?
Yeah, so I think the first thing to call it is at any time, really each company is like its own market. And so it'll have its own kind of premium or discount, kind of like how public stocks work. But we also see some trends across sectors, right? Some sectors are more popular than others. Some have done better than others. Some have raised more capital privately than others. So like off the bat, I think a couple that we've seen that have done well as far as kind of trading at maybe higher prices than historical. Industrials, emerging energy, those are two. And it kind of makes sense a little bit, right? A lot of the emerging energy companies are building tools or have been trying to build tools for very important like aspects of what's going on in technology, whether it's AI, right, and needing more computing power, or some type of energy replacement for increasingly expensive and highly regulated fossil fuels. So those kind of make sense. So we've seen those trade at, sometimes even a premium to the last funding round, meaning like people are willing to pay more than what the company last raised money at. And then I'd say like the other like overall barometer and something we look at EquityZen a lot, and I'm sure our competitors do too, is we kind of look at globally across all these companies. If you kind of average out, are we trading at a premium or a discount to the last funding round in mass? Where are we at? And it's kind of like a good kind of yardstick for where we are. So we saw that average kind of discount to the last funding round as low as I think 40% at the end of 2023. And we're seeing that kind of now get closer to 28, 25%. So we're kind of like on our way back, but still not at a point where companies are trading at the same valuation they were worth, call it, in 2021, right? We got some work to go to get there.
Yeah, so that's interesting. Are we headed then towards 2021? Do you think valuations are getting back there? It seems like investors over the past few years maybe got in at some good deals given that things were trading at such discounts. Are we totally veering away from that? Where do you think the market's going to go next?
So I think we are headed back towards kind of the valuations that were set in 2021, with the caveat that those valuations in 2021 were really, really high on a relative basis, right? On like where we were. So businesses that were doing, $100 million in annual revenue could be valued at $10 billion, right? So it's like 100x. And so the way you get back to a $10 billion valuation in 2024 is you're not going to get 100 times your revenue as like the valuation you'll get. You might get like 15 times your revenue. So that means that same company now has to get to, call it, 600 million or 700 million in revenue times 15 to get to 10 billion. So we are getting there, but what it's required is that companies have really got to shown and proven that they can grow revenue, get to profitability, et cetera. And so it's going to take longer than people think. The other thing I would say too is the way that companies get comfortable going public eventually, which is kind of what investors want when they invest pre-IPO, is they want to invest in a company while it's private and eventually goes public. A bunch of companies are only going to start trading or go public or go IPO if they feel comfortable that they're going to get a good multiple on their valuation and their numbers are ready. And so far in the first half of 2024, we've only seen a handful of tech IPOs. And I say handful, like I really mean it. Like you can fit it on one hand. And so that's not really like a great overall yardstick or vote of confidence for like the 1,000 other unicorns that want to go public. And so we're going to have to see a few more companies kind of test the waters, if you will, by going public, performing well, getting like a good multiple before you see others come out. And so it's great to see like this trend of the discount go from 40% to 28% and hopefully like starts closing the gap. But I think it's just going to take longer than people think. That's kind of the reality.
So we've framed the market where companies are trading, the sectors that are interesting and whatnot. What does this mean for an investor though? How would you advise investors to think about buying or participating in this market given where we are now?
So I think investors just have to be careful and do kind of extra diligence. That's the reality. If a company hasn't raised money in 3 years, right? The last time they raised money was in 2021, and they raised a bunch of it because that's what you were able to do in 2021. It's kind of hard to gauge how that company might be performing, right? Because there's no new data point that says, oh, they raised money again at this valuation. So we kind of talk about that as like information decay. There's just been like a lack of update means that like one must presume that things are not that great. So my encouragement to investors is to spend a little bit of extra time kind of like perusing through multiple opportunities, being a bit more scrutinizing of the information you get, being a little bit pickier, being a little more patient. Because what you could do in 2021 is, even if the valuation you thought was crazy, like somebody had recently put up a bunch of cash to say that that valuation was something that they were a believer in, right? Yesterday, this unicorn corp raises $100 million at a $1 billion valuation. Okay. Who are the investors? Okay. It was Andreessen Horowitz, and it was, a large sovereign wealth fund, and it was Fidelity, and they did a ton of diligence, and they decided the company's worth this, and we put down $100 million and bet on it. Well, that happened 3 years ago. Like anything could happen since then. Company could be mismanaged. The company could have pivoted into AI and done a really great job. You just have to just do a little bit of extra work, right? And that's why I think you also see like some of the data we've talked about is like there's some companies that trade at a premium to the last funding round, and there's some companies that trade at an 80% discount. That probably is a leading indicator of maybe like how that business has been run, or like if they're good or bad stewards of capital in the last couple of years. So just extra time spent. Got to be patient. You got to remember that like these investments are super liquid, but they have the potential to generate meaningful returns. Yeah, and if you're an investor and you want to take a look at these things, or you're curious, obviously you can do your own broad searches, right? Company you're following along, you'll see it on CNBC. You should start doing your searches. But you can also take a look on EquityZen, right? We'll provide publicly available information about the company. We'll aggregate it, summarize it, distill it. We have references to other things about the business model. And we also share, to the extent we can, a bit of data and visibility on how the company's performing, right? As far as recent trades, where, trends we might have seen in that sector. So a lot of things we've actually talked about today, and the data we share is something that we make available to users, after they log in, where they can look at trends. So I think it's just the more informed you are, better shot you have of picking the right investments that do well.
So especially as companies stay private longer, there are a lot more options for investors. So where are we seeing demand? Is it the young companies that are emerging? Is it some of the companies that have been around for a while? What's that breakdown, and why do you think that is?
Yeah, so you kind of got these two camps. It's a bit of a barbell. You've got kind of the OGs, we'll call them like the grandparents, the companies that have been around the block. They've got a good story to tell, pretty predictable in who they are. We'll call those like the older companies. And then you've got a bunch of new generation fintech, AI companies that are kind of like the babies, right? The infants. And if you think about it, right, both groups are fun to talk to. Grandparents have great stories. They're always nice. They've got a ton of wisdom. They know what it takes. Babies are fun too. They're bright-eyed, bushy-tailed. Anything can happen. The window of opportunity is enormous. And the reason why there's focus on both kind of makes sense for our space, right? The later stage, older companies, let's say a company that's been around for 10 or 15 years, is probably in a much better position to go public and like ultimately exit than an AI company that's 3 years old. While the AI company that's 2 or 3 years old may attract a ton of PR and attention and capital that they've raised, they likely don't have the infrastructure or the track record to be a public company. One of the things we keep an eye out for if a company's like ready to go public is who their CFO is, their chief financial officer. If that CFO has taken a company public in the past or has a lot of experience at a large publicly traded business, it's probably like a good indicator that that company could go public soon and they're getting ready for it. And so it kind of really depends as an investor on like what you're looking for. If you're looking to capitalize on tremendous growth in the AI space, you might look at these kind of newer generation companies, but know that there's tremendous amount of risk, right? We've even seen companies that raised hundreds of millions of dollars in AI, in like the AI space, run out of cash in like a matter of years because computing power is really expensive. But that's kind of like high risk, high reward. Or you could look at a company that has given updates that it's hit hundreds of millions of dollars in annual recurring revenue. It's gearing up for an IPO. It's reined in its spending. It has a path towards profitability. And you can make a bet there that company is the one that you want to invest in because it's likely it has a path towards exit and liquidity, which means you'll get a return. You don't have to wait as long. It's really ultimately up to the investor. But those are kind of the two areas. And unsurprising, the middle-aged, boring people in the middle don't really get any attention. But I think that's kind of the case for most spaces.
So we've seen really over the past year or two that AI, fintech, information technology have kind of remained some of the most in-demand industries amongst our investors. But what are maybe some of the industries that are growing in interest, the up-and-coming industries where investors are starting to get more interested, and they might be the leaders in the next few quarters?
One area that continues to be popular is in cybersecurity. This actually even kind of predates the big wave of generative AI. This probably started with an increase in geopolitical risk starting in 2022. And the joke that we have is that no CEO of a large company ever got fired for spending too much money on cybersecurity. It is an evergreen need for a business. And so we continue to see active interest there. Another one is really in physical materials that have kind of new potential and new use cases. So for example, bioplastics, carbon capture alternatives. These are more kind of like hardware solutions that have been made possible by a lot of leaps and bounds of technological improvement. So we've seen that area as well. 3D printing is one that was very popular for a while. Like this is like when I started EquityZen, so like 10 years ago, kind of hit a bit of a lull and is like now resurging again. And then lastly, probably, applications of tech in more what I'll call like hardware businesses. So that could be space exploration, that could be deep mining, things that require considerable CapEx investment, but are becoming more realistic and more feasible because software is cheaper, hardware is cheaper, et cetera.
To learn more about EquityZen and get started as an investor, visit EquityZen.com/investor and click Invest Now to start your pre-IPO investment journey.